It's Monday, February 3rd, 2020, and in this video we're going to talk about top 13 bear signs. No, we're not going to talk about the coronavirus because everybody else is talking about it, and unfortunately they're too late to talking about. We're going to shift our view to the 13 bear signs that are actually pointing to a severe drop in the market. That's got nothing to do with the coronavirus. So we're going to outline the specifics. Stay and watch this video till the end because we're actually going to reveal some exciting data, some psychological trading clock data. Thank you guys for the input you've placed in the comments in the last video. We're going to show you how you're going to be able to utilize this psychological data entries that you've put in the comments in order to help us nail the best entries this week. So let's roll without any further ado. The market is about to accelerate the crash, but not before it bounces higher. So contrary to the general consensus this morning on February 3rd, 2020, Chinese multi-billion-dollar stimulus to protect the market from crashing is actually not the reason to buy the stocks here in the United States. So at the end of the video, we'll show you exactly where stocks are headed based on the historic analog. And the historic analog actually helped us, along with the 13 markets move formula, nail that 600-point drop on Friday to a point. So utilizing this historic analog on day-to-day basis going forward could present some very high accuracy on day-to-day basis. So stay focused. Double-digit drop in sales in USA and worldwide for Caterpillar. Nobody's focusing on it. Nobody's talking about it because everything that they seem to be able to talk about right now is the coronavirus. So understand this, Caterpillar reports horrible report on Friday. Yes, the stock drops, but it should have been substantially lower because the type of sales numbers are recorded in Caterpillar. We have not seen such a huge rapid drop in sales numbers, not just here in the US, but worldwide, like until the pre-2008 levels. Okay, so this is something that nobody has been talking about, but this is crucial because this is actually giving us a bearish sign that things are really slowing, and they're not just slowing, but it's the pace at which things are slowing. Now notice, these bad sales from Caterpillar were reported before. They only represented the data before the coronavirus outbreak. So Chicago PMI and Chinese PMI, guys, these bad numbers don't, again, reflect the virus data yet. So officially, Chicago PMI, the lowest since December 2015. Guys, we're talking about 42.9. Are you serious? 42.9. Jesus. I mean, you can kind of sort of live with a 48.9. There were days, guys, in the past where the market would report like a PMI number of 48.9. The market would be down 500 points. Now they're reporting a 42.9, and the market is, you know, they don't blink. But that really tells you that even though maybe the market is focused on some other things, okay, and temporary, the market could ignore certain situations like this with the data, but it's not going to be able to ignore it for a long time because there's going to be more and more signs of this. This is just the pre-existing condition to more signs that we're going to see pretty much everywhere with the economy. So basically, for those of you not familiar with Chicago PMI, guys, it's an index that keeps manufacturing activity data, and it hasn't been below 50 since July. So the importance of this number being below 50, the number below 50 actually is indicating a recession condition. So the economy, you hear in the news, oh, it's so good, but what the PMI number is telling us that numerically, PMI index represents a recession now for 6 months in a row. So last GDP numbers were very weak. Now you may say, well, GDP number was 2.1. Leonardo, that's not bad. Well, guys, in relation to what? Think about this. We're only at 2.1 on GDP. We're only at 2.1 on GDP, what should be like 3, 4, 5%. Just think about the amounts of stimulus that has been injected in the U.S. Market in the last 6 months. Think about how they just cut the interest rates, combine that with lowest tax environment in the history. Guys, when you combine all these conditions, okay, the economy should be growing. But if you look at this chart, despite of all these activities and artificial actions to try to maintain the economy where it's at, guys, This is bad. This is bad from the standpoint, okay, if we're putting all this extra stimulus, if the Fed cutting rates, why are we not able to grow despite of all this increased activity? We're going from 2.1 to 2.1. We should be moving higher. There's no way that this makes sense. And if you try to draw sort of a longer time frame trend here, beginning of last year, right, a couple of years ago, this is a solid move from 3.5 to 3.1. We're down to 2.1. The situation is not looking pretty if you put things in the context of the type of conditions, stimulus conditions that we got right now. Now, the most important thing in this GDP report to understand is that consumer spending slowed sharply. Consumer spending slowed sharply. Now, market has been rising for the last year on the assumption that U.S. consumer is strong. We specifically posted a video about a month ago. If you have not watched it, make sure you review it today. Guys, market crash 2020. We specifically said one of the reasons we stated the market will crash by April 2020. All of a sudden, everybody's going to realize, hold on, U.S. consumer is not that strong. And once the market is going to come to that consensus and realization, okay, that's when the market is going to crash substantially, because it's going to defy the assumption everybody had about the consumer. So as soon as any signs that consumer is actually weaker than everybody thought, the market will begin to crash. Now, with that said, nobody has been talking about this Discover credit card situation. Do you guys know what TDR numbers are? Let me just explain real quick. TDR numbers is something that a credit card company would keep track of, because that number represents the troubled debt restructures, the number of troubled debt restructures. So basically, a person that would belong in this count would basically be those people that want a repayment plan on their credit card, not because they're doing well, but because of financial difficulties. This could have been a huge scandal, because I'm really shocked that more people are not talking about this, but basically Discover Financial, DFS, admits to huge misrepresentation in the number of TDRs based on the accounting practice that they've used. They actually apparently has been trying to hide a large number of these TDRs. And if you take a look closer, there's some other numbers in the reports that are concerning. The charge-offs are up 18 basis points, 30-day delinquencies are up prior year over year. All these stats, they are up. So apparently, they've been trying to hide a 1.1 billion increase in TDRs. Now that's huge. It's not like, hey, it's 100,000. It's guys 1.1 billion. So this is a huge issue. How Discover actually were trying to classify these customers that are trying to restructure their debts because of financial difficulties. Okay, and the way that they were reporting this, they were hiding 1.1 billion of those consumers. Scary stuff. When we're talking about weaker U.S. consumer, okay, credit card certainly is the first indication that consumer is indeed not as strong. But where else can we look at, guys? Anywhere you look at, right? Hey, more retailers file for bankruptcy. Now, that's been an ongoing story, and partially can say, hey, but it's because everybody's buying on Amazon right now. Well, the question we should be asking, and the question that we should be paying attention to, is, does everyone that loses a job that has been employed by a conventional type of business, do they automatically replace that job with a job in Amazon? So that could actually give us an indication, number one, why the TDR numbers with the credit cards are actually going through the roof, okay? And also, that could give us the most important insight into how to trade this week, and that is the job number. Okay, so temporary increase in the holiday season jobs are actually not going to be there this Friday, when the job number is going to come out at 8:30 to cover up the real numbers this time. So more companies like Caterpillar are actually beginning to lay off more and more people. There's more companies that are doing that. At some point, they're not going to be able to cover up these numbers. And I think that Friday is actually going to be this Friday, February the 7th, guys. So February the 7th could be a huge catalyst to the markets actually moving lower. So along with our theory that we presented a month ago in this market crash video of 2020, the main theory, again, is based on the weaker U.S. consumer that the markets have been mispricing for quite some time now. part of the theory stated in that video was the fact that as dollar actually drops, United States consumer strength is going to take another hit. It's going to deteriorate. And this is exactly now a month later what we show on the dollar chart. Dollar creates a solid downward spiral and it continues to drop. That is another sign, another bearish sign that could definitely make the U.S. consumer weaker and cause some other issues with credit card companies, student loans, all these other things. And at some point, this domino effect accelerates rather rapidly, and it's impossible to stop it. So rate of change in the drop of oil, guys, remembers the rock rate of change, guys, in September, October, November, December 2018. Now, we all know it's not about oil going higher, oil going lower. Okay, it's the speed at which oil prices are doing so that creates some substantial drops in the market. You know, prices on everything, they're supposed to go up and down, okay? But you get these overwhelming larger drops in the stock market in response to conditions that are not typical. So this is not a typical condition when apparently you have every catalyst for oil prices to actually move higher, and they doing exactly the opposite. Everybody's selling oil, and especially when you look at the chart, you got this death hook formation when the blue line is about to cross this orange line. If this takes place, guys, oil prices could be in the 30s. And last time oil prices were in the 30s, guys, the market tanked badly. Okay, so with that said, the important thing to pay attention to is OVX. A lot of times we're talking about the VIX, which measures the volatility in the S&P 500 and so on. But this time, when you're trying to really get a good measurement of oil pricing, okay, the most useful chart in order to do that is OVX, which tracks oil volatility. So when you're looking at those things, OVX is in a solid uptrend, and it could easily hit not just this 77 level, but check this out. Yes, it can hit 100. Last time we hit 100, guys, it coincided with the December drop, which we actually predicted while 13 markets move formula, December of 2018, that is, or the day before the Christmas day. So, guys, very important stuff is developing on this OVX volatility of oil chart. Pay attention to it. The way the chart looks right here, it could break out rather sharply, and this will get everybody's attention if oil begins to break some key levels. Now, the situation is so scary at the moment that OPEC, is looking at an emergency meeting. Yeah, guys, please understand, OPEC doesn't do any emergency meetings unless it was something serious, unless precisely they thought that oil could actually temporarily drop to 28 or 36 range. Okay, now, generally, you wouldn't expect oil prices to stay at the lower levels, as the history shows, for very long, but it's important to understand that they could actually drop there, and the fact that they scheduled in this emergency meeting is not something not to pay attention to. So, but the question is, as they're scheduling an emergency meeting for oil prices, who will actually schedule the emergency meeting for copper? Guys, look at this chart. Whoa, missed that one, did you? Death hook tells us that copper prices could still go lower. Now, important to understand, it doesn't mean that first copper prices could not stage some kind of bounce. They're likely to do it on Chinese stimulus, but don't underestimate the probability of a reversal going forward from there. So copper rate of change and the price drop that I just shown you the chart, guys, it's highly alarming. But it's this next chart that makes it even worse. And it's the gold prices. Okay, gold prices on the verge of breaking out to 16, 17, 1800. See, and the important part here is to understand that there were a few instances in the history where we had copper dropping, but gold was not doing a whole lot. We had that situation where oil was dropping, gold was not doing a whole lot. But when we have circumstances in the market when you have oil dropping sharply, copper prices going sharply, and the only thing that's actually going higher is gold, okay, that is a situation for a huge drop-off in the markets, okay? And at this point, we could see the markets tank 15-20% by the end of the year. what we're targeting, though, from the standpoint of trading weekly options, we're targeting the shorter term move. So at the end of the video, I'm going to give you a specific answer. How low can we go in the short time frame? So in order to do this, let's take a look at the historic analog that highly resembles current market environment. So first, I'm going to just a quick glance, a reminder of the chart where we studied the history of SARS in 2003 and what exactly the reaction was on the chart and what time frames. So far, we still make two more legs down if we go with the historic analog from 2003 on the SARS virus. Okay, so basically 2 weeks ago we were here, now we're here. We can still make this leg lower and another leg lower. Now notice they don't come without bounces to the upside. So the bounce that you're seeing pre-market based on Chinese stimulus, guys, that is an awesome opportunity to short. I'm going to show you exactly where to pull the trigger in just a second. So for all the details, guys, if you missed out last few videos about the details on the SARS virus, we actually pointed out top 2 viruses in the past 15 years and had a profound impact on the market and outlining all the variations of things that could have happened. So if you missed that video, it's a lengthy video. It's about 50 minutes long, talking about all the details, also disclosing the 13 markets move formula sequence that have predicted this crash on January 31st. So you can go ahead and review that video. Now, the historical chart we want to focus on right now is the December, January, specifically this time frame in January, rolling into February of 2018. So we're right here. Okay, we're about to do this. In order to understand the day-to-day action, we're going to zoom in on this historic analog, and we're going to show you what exactly in Dow Industrial Average did. This red point, we're going to use this orange dot as a representation of market close on a Friday of, now Friday was January 31st, 2020. So use this as your day-to-day action for the next 8 days. Now, if we study this historic analog from this red candle to this candle right here, there was a total move of about 2,800 points. So if we apply just the point change, which is actually going to be a slightly lower estimate because the market is actually trading slightly higher right now, so we convert it to percentages, we can actually get a lower number. But just going off the points, okay, Dow Jones can easily lose 2,800 points in the next 8 days. 2,800 points in the next 8 days will put Dow Jones, okay, at a level of about 25,831 in the next 8 days. Now understand, bounces are your opportunities to short. This is not the time to buy the dip, okay? If market really wanted to use this Chinese stimulus, okay, as a reason to rally, would have already had a much bigger rally. The Chinese stimulus, please understand, is not a reason for the market to rally. By no means it is new news. It's been talked about in the last couple of weeks as one of the measures the Chinese were going to end up taking anyways. So this is not new. It may appear to be new because this is the first time you may be looking at it, but Chinese stimulus is not something new, guys. If you study the history of Chinese stimulus, it also always boils down to the amount of the stimulus, and it boils down to, you know, that every time they announce more stimulus, it has less and less effect and reaction in the markets. So far we're getting a bounce, which is a great opportunity to actually come in and buy some puts. And again, I'll show you exactly where. So last time, if we look at the historic analog on the S&P chart, this would be the representation of the Friday action that would be equivalent to current day of January 31st, 2020. Notice what happens for the next 2 days, right? The market actually, after that, it does go higher. Okay, if we were to get down specifically, the market does bounce. It also makes a pullback. Okay, that's what this black candle represents. It bounces, makes a pullback. So basically the market trades in a range. I'm going to show you what range we're going to be trading in today. Then comes Tuesday. So this would be today, Monday, February the 3rd, if we're to convert it to the current time from this historic analog. Tomorrow, February the 4th, the market's going to look like this. We're going to make another possible bounce, but this time we're not going to end like in the middle of the trading range for the day. We're actually going to end closer to the bottom of the trading range Wednesday. Huge gap down, drop. The next day, Thursday, bigger gap down. We try to close this gap higher. It ends up being a big down day. Friday, we're hitting the lows, we're bouncing, followed by another bounce on Monday, which is going to reverse, followed by a huge drop on Tuesday. Okay, and ultimately next Wednesday, expect the market to set the bottom. So this is the time frame for everyday trading for the next few days, guys. And considering how accurate this historic analog has been, guys, if you pay attention to this and if you understand what these candles actually are and how to trade them, guys, which we talk a lot about in our charts, patterns, and divergences course. Okay, by the way, you can enter the contest to win this course by placing your best trade of the week from following this channel. Okay, so guys, if you haven't gotten all the details about the contest, review the last video that's called The Psychology of Trading in order to get the details on that. Now, S&P 500 officially using this historic data could drop to a level of 3,025. NASDAQ could drop, based on the historic analog, from here to here. 8 days, says 6 days, is supposed to say 8. 13-point drop would be equivalent. Still got 11% to go, so that would actually put us on NASDAQ at a level of about rough 8,200, give or take, 100 points to the upside or the downside from this number. Move 9 is something that we've pointed out and focused on the last couple of videos, which presents a huge shift in the market direction. So our 13 markets move formula is just pointing to another leg lower in the market, represented by the simple sequence 9, 4, 3. So pay attention to that. And if you don't know what 13 markets move formula is, guys, click the link below, take action, and learn more about it. Now, here's the cool part. The psychological trading clock data, guys. Here's the deal. The data is in. We've broken down the numbers. Basically, for those of you that have not followed it in the last video, 0 represents, hey, I don't believe there's going to be any more crashes. The crash is done. It's time to buy the dip. Basically represents by number 0. And it was from the number of respondents, which we basically, so we got 15% of those that responded. They are at 0. They don't think that the market's going to crash and it's time to buy the dip. 3% are thinking, hey, maybe I should start buying some puts, but probably not because the market is not going to crash. Okay, 6 is like, hey, I'm really thinking about buying some puts. And 10 represents is like, damn right, I need to buy some puts right now because I think the market is crashing. So we got 15% at a 0, we got 15% at a 3, we got 36% at a 6. Now this number has huge importance because that is telling us that watching the bump today in the market's trading slightly in the green pre-market. Okay, a lot of these people, the 3s, that are like, hey, I'm maybe thinking about some puts, but like, no, overall, I don't believe the market's going to drop. Like these people this morning, looking at the price action, they're going to get closer to a 0. Okay, these people that were at the 6 last night when we're thinking like, yeah, I'm probably getting really ready to buy some puts. I'm really thinking about it. Now that they see the market go higher this morning, they're going to be like, no, I'll just, I'm not going to do it. And they're going to change their mind. They're more likely to move to like a 0.3 or 4. Okay, so that tells us we're only left with about 34% of the people that really still believing that the market is about to crash. Now, as I identified, if you go through this video thoroughly that I posted yesterday, it is a lengthy video, but it really is trying to specify some key psychological points when it comes to day trading, guys. So make sure you review it in order to make the best use of this information right here. So basically what this psychological clock is telling us right now, that the overwhelming majority is not yet 100% convinced that the market can crash. That actually leaves room for the market to crash. Because what we want to do, we want to buy puts while the overwhelming majority is still not 100% convinced of the crash. We want to sell when the overwhelming majority moves right here between 6 and 10. We want to start collecting some profits. So when this number of people being at the 10 moves to about 50, 60, 70%, and this number gets to about 30, 40%. So that's going to leave very room for these first two numbers. That's when you know it is actually time to collect some profits. So that tells us what we should do is short the market on the bounce. Here are the key levels if you're a day trader that you should know for today. Short the bounce to 32.63. So you start buying some puts here. Short the bounce at 32.81. There's very low probability we're actually going to go above 32.81. So that's your ideal entry. Now understand, you should not be utilizing your entire account to do that because based on the historic analog I've just shown you, what is the day starting out tomorrow? The day tomorrow could actually start out with another slight move higher. Now, for trading today, these are your key levels because once the market hits these levels, it has a high probability of a reversal. So it's going to keep going up, down in this range between 32.40 and 32.80. So once it gets here, it's likely to make a pullback, another bounce, another pullback, and so on. So target this range, 32.40 to 32.80. Okay. Tomorrow, the market could still revisit one more time this level of 32.90, 32.95. Okay, so understand that. You can day trade using these ranges today. Your ideal entry point, if we follow the historic analog down to a T, okay, it's going to be tomorrow in the morning when the market could bounce slightly higher one more time. Now, also understand the historic analog may not be 100% as far as the intraday moves. So just because the historic analog points that could be a move higher slightly again tomorrow morning, it does not mean that it's actually going to happen. So there's still a probability in the market like this that the market could gap down after hours. So you don't want to go put a big position to keep it overnight, but you want to have some. But understand that there is a greater probability that the market could actually move slightly higher. So with that said, you want to buy puts on the bounce as the overwhelming majority still believes that the crash is not coming, which is going to get you a best possible entry. So guys, with that said, trade like a rock star. I'll catch you on the next trade soon. And if you're new, you guys want to get some specific trading levels for individual stocks, get better understanding how to use the 13 market smooth formula, guys, don't wait, make it happen. Click the link below and get started. The link below this video in the description. Let's go.